It's my humble privilege to be here to talk about mobilizing public, private, and blended capital to deliver the Southeast Vision 2050. Obviously, I'm surrounded by very distinguished experts in the financial services industry. So I'll try to make this very light-headed and snappy so that we can get to the subject of the day and have a more interactive engagement. My intervention will be in two sections. First, I will talk about the scale and nature of the financing needs required to accelerate the development of the Southeast region. And then secondly, I'll talk about the pathways to mobilizing capital in order to achieve SEV2050. So, let's start by spotlighting the Southeast, the 5 Southeastern states of Abia, Anambra, Ebonyi, Enugu, and Imo State. And you can see the size of the landmass. They all contribute to a total of just under 30,000 square kilometers. In terms of population, the region contributes 27.6 million people based on estimates as of 2024. In terms of GDP, you're looking at a total of 34 trillion naira. And in terms of internally generated revenue, and this is using the number for 2024, we couldn't get all the data for everyone for 2025. We've seen a total of 300 trillion naira. But if you contrast that to the FAC, the receipts from the federal accounts, contributions, the amounts they get from the federal government every month, the total comes to just over 1.1 trillion naira. So clearly there's a big gap between what they receive from the federal government and what they're able to generate internally. So there's work to be done there. But if you put the Southeast region as one block, the most likely country you might want to compare it to will be Rwanda. Again, similar sizes. Southeast at 29,000 square kilometers, Rwanda at 26,000 square kilometers. Population of 30 million compared to 15 million. GDP of $22.7 billion compared to $14.3 billion. But GDP per capita now falls down because of the larger base of population in the Southeast at $821 per person compared to $1,000 per person in Rwanda. The main economic drivers in the Southeast, manufacturing, agriculture is missing there, trading, of course, small and medium-sized enterprises. In Rwanda, however, it's mostly services, tourism, ICT, and agriculture. Now, the differences now begin to show. In terms of road network, the South here has 26,000 kilometers of roads, only 30% of which are motorable. In Rwanda, they have 38,000 kilometers of road, most of which are very motorable. Electricity access, we have 75% that have access to electricity. It doesn't mean that they get it 24/7. Most of us in the cities can acknowledge that the power supply is very intermittent. In Rwanda, however, we've got 85% access to electricity, and electricity is quite stable. I've been to Kigali many times, and many of the hotels don't even understand the need to have a generator, a standby generator. And that shows you in the grid power allocation in the Southeast, we are barely getting about 70 megawatts of power from the grid dropped into EEDC, while Rwanda has over 406 megawatts of power. And that is the differentiating factor. But let's step back for a moment and look at the infrastructure gap. According to the World Bank study, Nigeria needs over $3 trillion of investment over the next 30 years in order to bridge this infrastructure gap. This will mean an expenditure of about $100 billion per year for the next 30 years. If you understand that the Southeast represents about 10% of the GDP of Nigeria, and this is not to understate the size of the Southeast, it's simply because Lagos as an economy takes a lion's share of about 40% of Nigeria's GDP, and so as a region, the Southeast takes 10% overall. That's quite sizable. And if you look at infrastructure from 5 key sectors, I take power as number 1. And this includes, obviously, generation in terms of, as well as transmission and distribution, investments required in renewable energy, investments required to do more captive power plants, such as geometric power in Aba. And you can see sometimes when there's a grid failure across the country, there's light in Aba. The gap is estimated at $17 billion just for power alone. And that is over the next 30 years for the Southeast. If you look at transport and logistics, this will include roads and bridges, rail, ports, water transportation. You're looking at a gap of nearly $14 billion over the next 30 years for the Southeast. And if you look at telecommunications, including fiber optic backbone, last mile connectivity, mobile telecom towers and fiber optic networks, and data centers, these are critical for us to move into the new economy. All this talk about artificial intelligence, remote working, they will fail woefully if we don't have telecoms infrastructure. You're looking at a gap of about $6 billion. If you look at industrial and agricultural infrastructure, and here we're referencing mechanized commercial agriculture and access facilities to those areas, storage and processing agro-complexes, agro-processing industrial zones and industrial parks, you're looking at a gap of $10 billion. And last but not the least, if you look at social infrastructure, and here I'm referencing healthcare infrastructure, educational infrastructure, as well as security infrastructure, which is critical to ensure that any investment is protected and that the human capital required to support these investments are available and nurtured and learned. You're looking at a gap of $8 billion. So in total, the Southeast has a gap of $54 billion over the next 30 years. That's a lot of money to close the gap. But collectively, we can do a whole lot. And this now leads me into the second section of my intervention, which is, what are the pathways to mobilizing long-term capital? And what are the constraints, whether real or imagined, that we are facing today? Let's look at capital from a tripartite point of view. There is public capital, government budgets, grants, financing from government-backed institutions. Like I showed you in one of my opening slides, the Southeast in 2024 received 1.1 trillion naira from the federal government, and amongst themselves raised only 300 billion naira in terms of internally generated revenue, giving a total of 1.4 trillion naira that they were able to raise from public sources. If you add grants and loans, you could estimate maybe another 200 to 300 billion. And so the expenditure from the Southeast region in 2024 would not have exceeded 1.7 trillion, just from public capital alone. We'll look at the private capital side, and this will be funding from banks, from institutional investors, from private investors, from corporates, from retail individuals like all of us in this room, and of course from our diaspora brothers and sisters around the world. And then we will also look at blended capital. This is where we combine the merits of public capital with private capital in order to fund particularly long-term infrastructure projects that are required to drive the growth of this region. Now, public capital, constraints to potential optimization. We clearly have seen over the years an over-dependence on revenue from the central ports from many states in Nigeria, and the Southeast is not very different. There has been, secondly, poor innovation towards crystallizing revenue potential, and I say that from the point of view of showing that the internally generated revenue of all the 5 states combined is coming out to just about a quarter of what they are receiving from the center. I dare say there is capacity for the Southeast to be able to do at least 2 times of what they are getting from the center. And so, if as a group they receive 1 trillion naira, they should be able to raise at least 2 trillion naira themselves every year to be able to move that expenditure level to 3 trillion. Again, the third point is weak economic coordination among the subnationals. I think one of the most remarkable things that happened this week was seeing the 5 Southeast governors represented in one voice for the first time in memory in this room. And all of them speaking very strongly of their intention to coordinate and collaborate to drive the development of the region. And I have to thank the Southeast Development Commission, Mark Okoye and his team, for this laudable achievement. And then last but not the least is policy inconsistency. And this is critical because if we want to drive investment into the region, we have to act as a bloc. And a simple example would be if you want to attract international manufacturing companies like Daimler-Benz to set up, or a GlaxoSmithKline to set up, many of these people will look at the laws from across the different states and expect that it's harmonized in terms of land laws or business permits. And that's one of the things that we can do ourselves to improve the potential to generate more revenue from the public side. But if you look at the IGR, and this chart is a bit busy, you can see there's huge untapped potential to increase IGR. Enugu has shown a very startling example. In 2022, the IGR in Enugu was 28.7 billion naira. In 2024, it had risen to 180 billion naira. As of 2025, based on public sources, it had reached 400 billion naira. This is unprecedented, and I must acknowledge the government of His Excellency, Governor Peter Ndubuisi for this laudable achievement. But if you can do that, it means that there's huge capacity in Imo, certainly in Abia, definitely in Anambra, and so also in Obonyi, to grow their IGR. Because prior to this present government in Enugu State, anybody else would say that Enugu is a civil servant state and there's no money there. But this is the same state that is now topping 400 billion naira in IGR. So there's more, there's capacity, and we just have to show that innovation and creativity for growth. Moving on to private capital, what are the constraints? The constraints unfortunately, when it comes to private capital, are self-imposed. It's not really anybody that's limiting any of the states from raising money from the private sector. You have basic things that the private sector requires, which is transparency and disclosure. Any entity that wants to raise money from the private sector must be willing to show that it is well governed and can produce audited accounts, can produce transparent information that is consistent across different ministries, departments, and agencies of government, must have the discipline to maintain that quality of information year on year, must have the discipline to respect the contract it enters into as a state, must have the ability to be accountable not just to its citizens, but to its stakeholders, because before you go and take money from the private sector, they want to see that you have the capacity for accountability. And any constraint here, I would say, they are really not constraints. There are things that each of the states, if they focus their minds to do it, they can resolve in short order, because Lagos State is doing it. Last year in November, Lagos State raised 243 billion naira from the capital market in two transactions. One at 215 billion, a plain vanilla bond, the rest was a green bond. And that was taken from the same capital markets that we all are watching here in Nigeria. And that is because Lagos State is PENCOM compliant. To be PENCOM compliant means that the state has joined the defined contribution pension scheme, and all its employees are part of that scheme, and they are contributing on a monthly basis, and they have the necessary documentation to show to the pension fund industry for them to tap funding from that market. If you look at the domestic pool of capital available, and not stepping outside of Nigeria, today, the debt capital market is at 70 trillion naira in value. The equity capital market, the value of the all-share index is at 100 trillion naira in value. The pension funds industry, the amount of money we have pulled in our pension fund is 27 trillion naira. And if you look at the diaspora remittances, last year, Nigeria received $23 billion, of which an estimated $4 billion came to the Southeast, mostly for consumption. This is equivalent to 6 trillion naira. That tells you the capital is not the issue. Capital is available. It is the discipline and the commitment and focus to get that capital that is lacking. And if you look at these numbers and compare that to the revenue of the states, remember, I showed you, in 2024, they collected 1.1 trillion from FAC, and they raised 300 billion amongst themselves in internally generated revenue. But compare those numbers to what you see in terms of the domestic pool of capital available. It means here we are as a region where there's money all around us, and we have decided not to go and get it. The paradox is similar to Nigeria, which is sitting on oil and gas, and we sometimes have scarcity of petroleum, and we don't have the gas to fire our industries, and we are wondering what is wrong. We have the capacity, we have the intelligence, and we have the tenacity to fix this problem, all within this room. And if you go specifically to the pension fund sector, of the 27 trillion available, about 1.3 trillion is available to state governments to raise as bonds. Set aside the ones they can raise if they do structured investments through specific vehicles. Of that 1.3 trillion, only 240 billion has been taken, and that was taken by Lagos State, and you've got over 1 trillion naira waiting for investors, waiting for projects to fund. And this is part of the challenge we are seeing in terms of our capacity to mobilize capital. And lastly, let me look at blended finance. And this is a very wide subject. But I just want to use examples to illustrate this. About 16 years ago, the Azura power plant in Edo State was conceived by some creative investors. Some of them are in this room. The shareholders, the idea was to raise $900 million to build a 461 megawatt power plant, a greenfield power plant from the scratch. But in order to conceive, to get the idea to move, the investors, Amaya Capital, Actis, Africa 50, and a few others needed the federal government of Nigeria to give some guarantees. And the government gave two guarantees. One is what they call a partial risk guarantee. This guarantee says, when we build this power plant, you must take the power. If you build a 461 megawatt power plant, every month we'll send you an invoice and you must pay us. We don't want to know what your problems are, you just must pay. And the government gave that guarantee. The second guarantee is what they call a put-call option agreement. And this agreement essentially says, if at any point the federal government decides to cancel the contract for the power plant, then they will have to pay the investors their entire $900 million within a specific period of time, and I think that was 20 years. So, with those guarantees in place, these investors went and mobilized over $800 million from development finance institutions, including DFC, IFC, British international investors, and at least 10 other investors, and raised the $900 million and built Azura Power, and that plant today supplies more than 10% of any power available in the country at any time, and is actually regarded as the best IPP in Nigeria, bar none. That is what blended finance can do. But it's not just international investors that do blended finance. Closer to home, our own Mofi, the MD of Mofi is here, Dr. Armstrong Takang, and the DG of the SEC is here, Dr. Timi Agama. Between Mofi and SEC, they structured a blended finance to intervene in the real estate sector of Nigeria. You know, Nigeria has a claimed deficit of 28 million housing units that needs to be built. But the issue has always been, how do you find mortgages at single-digit rates, interest rates, with long tenor? You find that it's not the ability to pay, it is the cost of the money that makes it difficult for people to afford to buy homes. So if a house costs 20 million naira, for example, and you can borrow that money and pay 9% per annum for 10 years, most civil servants will be able to afford that house. But if the same house costs 20 million naira and they had to go to a commercial bank and borrow at 35%, every 2 years, they'll be owing double the amount they borrowed. So it becomes impossible for them to repay that loan. What we then did with Mofi Real Estate was to set a fund size of 1 trillion, get the federal government to subscribe in the first tranche of 150 billion at a very reduced interest income to the federal government. And then we then subsequently came to the market and raised another 100 billion from private investors at normal interest rates. So as a result, the blended financing cost available to people is now at single digits. And this is an example of intervening in the local market using the capacity we have in this room. Bear in mind, I was just saying this transaction was done within 1.5 years. And that is one organization. The total IGR of the Southeast in 2024 was 300 billion. And one organization organized 250 billion. It tells you the capacity of what is possible. So on that note, I'd like to round up my presentation by echoing a call to action for all the Southeast states, and in particular, the Southeast Development Commission. You must commit to developing region-wide feasibility plans. In addition, you must commit to setting up a project preparation funding for that. I can say it, even at MOFI, we have 5 billion naira set aside for project preparation funding. And if you go around all the 5 states and raise 5 billion naira from each of them, which is not difficult to do, you have 20 billion to join with MOFI and be able to do more project preparation. Because the quality of your investment is tied to the quality of the business plan you present. You just can't wake up overnight and announce a project. You need time to study that project. Like if you're going to build a regional railway line, or if you're going to build a new power plant to serve the region, it needs time to be planned and to be developed properly. On top of that, you need to focus all on what is most important. With all the needs that we have, I must say that power is critical. We must start with power. If we can put more power, we can then power the industry, power the transport systems and the logistics that will unlock trade and agriculture and be able to unlock the high potential of the region. Thirdly, we cannot play with insecurity anymore. It is the biggest dampener to investments. If there's insecurity, no investor is coming here. The estimated amount that the Monday sit-at-home issue has caused the Southeast is running in the trillions of naira to date. And very few states have managed to come out of that shackle. Enugu, as an example, and a few others, but there's more to be done. I saw Governor Soludo a couple of weeks ago still dealing with this issue with the traders in Onitsha market. And it is very critical that we resolve insecurity because that is blocking access to capital for the entire region. Number 4, it's what I call align fully with private investor rules of engagement. No longer can we continue to pretend that we can get away without auditing our accounts or without being PENCOM compliant, without doing the things that allow us to raise money from the private sector. Because private capital is running at 100 times more than what the government capital has. And just that discipline alone will open up a complete waterfall of cash and opportunity for the region. So we must align fully to that. And lastly, because we have at this moment a platform that never existed, while I recognize that it will take time for the 5 Southeast states to become compliant, the SEDC can itself start tomorrow because it's already compliant. It has enabling legislation. I can lead the charge in unlocking trillions of naira of capital, both domestically and internationally, to transform the Southeast. On that note, ladies and gentlemen, I thank you very much.